Back in 2020 or 2019, Congress changed the rules for non-spouses who inherit IRAs. So prior to January 1st of 2020, if you inherited an IRA account from someone who was not your spouse, you had fewer options on how quickly you had to take that money out. Prior to that ruling, for most cases, you could take that money out based on your life expectancy, which means that you could stretch the distributions and stretch the tax consequences on those distributions over your lifetime, making it very manageable. Most people have the traditional kind of IRA, which is a pre-tax IRA. You get a tax deduction when you put money in, which means that you don't pay taxes on that money. You get to defer it or postpone that tax liability to later down the road after you've grown it a whole bunch and then take it out. So this ministry has been long in the camp that we need to not have all of our money in qualified types of accounts. And for a couple of reasons. Number one, because the government can and does change the rules on those, with the government being, with we the people, really, is the truth of it, being more than $31 trillion in debt, spending way more. I think the latest number is around $3 trillion more than what the government is generating in tax revenue. So we're operating at a deficit, spending money that we don't have. It becomes more and more likely that taxes will be higher in the future than what they are today. So one thing that is going to create a significant amount of revenue for the federal government, as you know, baby boomers are retiring, more and more people are inheriting IRAs. When that non-spouse inherits an IRA, they can no longer stretch out that for most cases. There are exceptions to the rule, but for the most part, they can no longer stretch out those distributions and taxes over their lifetime. They have been given 10 years to do it. So can you imagine inheriting $1 million IRA, being 55 years old, making the most money that you've ever made in your career, and having to look at taking out $1 million from an IRA and adding that to your income over a 10-year period? Well, that's what's happening, and it's accelerating the rate which the government is going to get that tax revenue that has been postponed or deferred for so long. So there was lots of questions about, you know, can I just wait 10 years and take it all out at that time, or do I have to take out a little bit every year? And the IRS wasn't clear on that. Under the first 2 years of the plan for 20 and 21, just a couple of months ago in September, the IRS clarified their rules, making heirs take out annual withdrawals during that 10-year period in cases where the owner was already subject to the RMDs. So what does that mean? If the person that you inherited from died after January 1st of 2020, that's the key date. If it was before that, you just continue on like you always had. But if they died after January 1st, 2020, you're a non-spouse, and they were not taking required minimum distribution, so they hadn't reached that age, that required minimum start date, then you still have just that 10-year period to get it all out. Now, if the person that you inherited the IRA from died after January 1st, 2020, and they were already taking their required minimum distributions, then you must continue to take a required minimum distribution every year based either on your life expectancy or theirs, whichever is younger, and you must have the balance out by year 10. So the IRS has said that they will issue some waivers if you were in this situation, you were supposed to be taking RMDs, but you didn't. So they're not going to assess penalties for the years 20 and 20 or 21 and 22. But they will start doing this in 23. So if you find yourself in that case, make sure that you get some good advice and get some clarity around what you're supposed to be doing there.